Welcome to Money Talks. I'm Cathy Yang, your intel on the Philippine markets and the economy.
In case of growth of that market itself, maybe it wouldn't, the way the pacing it will slow down.
Proposed online gambling restrictions may slow the Philippine gaming industry's boom, says Han Resorts. An excerpt of my thought leader's interview with Chairman and CEO Dae-Sik Han. And U.S. President Donald Trump announces a trade deal with Vietnam that would allow American goods to enter the country duty-free. The Philippines remains a lower middle income country after falling $26 short of the World Bank's threshold for an upper middle income status. The World Bank's latest country income classification showed the Philippines' GNI per capita reached a record of $4,470. While this was higher than the $4,230 the previous year, it is still below the $4,496 cutoff for the next income bracket. Vietnam slightly edged out the Philippines, while neighbors like Malaysia, Indonesia, and Thailand stayed in the upper middle income tier. The World Bank sees the Philippines reaching upper middle income status around 2027 as growth slows and structural issues persist. Experts say hitting that goal will need stronger growth, more investments, and big improvements in agriculture, manufacturing, and infrastructure. A new Senate bill for tighter regulations in online gambling could slow the rapid growth of online gaming in the Philippines. But for Han Group CEO Han Dae-Sik, the slowdown is expected. In an interview on Long Conversation Thought Leaders, Han says he understands the government's move to regulate more strictly, citing the societal risks linked to the rise of online betting platforms. He describes the regulatory push as both reasonable and foreseeable. Still, Han remains confident that his investment plans will remain unaffected. That's because his business is built on omni-experience, a seamless integration of both online and offline entertainment models.
Well, in case of growth of that market itself, maybe it wouldn't, the way the pacing it will slow down. But, as a government, as a regulator, it is very reasonable for them to come up with something stricter like regulation because, there is some kind of negative side in the society. I see that. So it is very foreseeable for me to see this regulator will come up with something stricter. But to me, whatever I'm doing right now is not only about online. It's about online, offline together, omni experience. So it won't affect any of my plan.
Han Group CEO Han Dae-Sik. Catch the full interview on Long Conversation Thought Leaders only here on One News. The Philippine Economic Zone Authority, or PEZA, reported a 59% increase in its approved investment pledges for the first half this year. From January to June, PEZA approved over 72 billion pesos in investments, up from 45 billion pesos in the same period last year. Despite the strong first half, investment approvals fell in June to 6 billion pesos, down by 30% year-on-year. Still, 31 new and expansion projects were greenlit last month, expected to generate over $166 million in exports and create 3,600 jobs. After this performance, PEZA Chief Tereso Panga says he is optimistic that PEZA will achieve its targets this year of at least 235 billion pesos in investment approvals and a 5% increase in exports and employment. For more on these stories, check out Business World Online. at our markets and see how they're trading. The Philippine Stock Exchange opens this Thursday lower by about 0.25% at 6,401. The local bourse slipped marginally, down by less than 0.1% on Wednesday. On the second day of the effectivity of the Capital Markets Efficiency Promotions Act, or CMEPA, retail trade volume turnover remained strong at 7.62 billion pesos, which could be attributed to lower stock transaction taxes, according to PhilStock's financial research manager, Japhet Tantiangco. The figure is well above the year-to-date average of 5.73 billion pesos. As for the Philippine peso, it opens today slightly stronger, 56.33 to the dollar. The peso closed yesterday a tad weaker at 56.365 against the greenback. And the Philippine 10-year government bonds have settled on Tuesday to 6.276% from the previous close of 6.336%. And with us now for more is Cristina Ulang, Research Head of First Metro Investment Corporation. Good to see you, Chris. Welcome back to the program.
Hi, good morning, Cathy. Happy to be here.
All right, so the Philippines remains a lower middle income country, says the World Bank. We've been stuck in this classification and we're the only ones left among the ASEAN founding members. What do you make of it?
Well, I think this is a wake-up call. We need to have more attention and more focus on what we really need to do. Government policy should be focused on really top priorities. And to my mind, it's really about our vulnerability to all of these geopolitical uncertainties, which means we should be addressing like our energy sufficiency, our food security, and our resiliency versus climate change. Because these are our vulnerabilities. We are not a net oil so we are a net oil importer, and so whatever happens to the Middle East affects us, our inflation, our deficit, and also debt sustainability. I think we have to address also how long is this going to be on the rise, our debt and our fiscal consolidation, also our budget deficit. How do we manage it? I think this is going to be a reality check, a reassessment of our priorities and where we have a lag in terms of our policy support and our structural reforms, where we have been lagging and where we have done better.
It's a clarion call, a laundry list of homework for the government as well as the private sector. But what do you think of CMEPA? That came on earlier this week, an improvement for capital markets, lower transaction taxes. Retail and trade value turnover have improved. I've seen it at least 7.5 billion pesos for at least two straight days.
I think, it's a very good start. It's a positive signal, really, that this is enticing investors to trade more. And I think this is going to put us on the path of growth, more interest in the local capital markets. Although we still have a lot to do based on what the BSP is saying, we still need to have a more realistic fixed income market in terms of the yield curve signals. And I think that it depends on the greater participation of even the smaller players and the big players in our fixed income market. And also in terms of the debt issuance, the governor of the BSP is saying that we should have more low-rated issuers. And so that should increase the participation in the capital markets, not only the AAA issuers that should be there. And also our participation also in the global ETF market. It's the high time for the Philippines to be there, receiving passive investments from investors who want to bet, global investors betting on the resiliency of Philippine GDP, which is actually is still the best among the top 3 in Asia Pacific, even though World Bank is saying we have lagged. That is, I think, a long-term concern. But in terms of the near-term growth prospect, we're still there, 5.5, 5.6%. Our inflation is 1.3%. Our unemployment is 4%, even better than the pre-pandemic of 5%. So we are really on the growth path. It's just that we are vulnerable and affected by all of this tension in the Middle East, oil price spike, and then climate change, the weather also. And we need to really have a fuel mix already for our energy transition program to lower our energy prices.
Yeah, but as you did mention, there's a lot of leeway, a lot more opportunity in the fixed income market. But right now with CMEPA, there's a lot of opportunity for the retail, the local and the small players. But what really is to come on for them? If the lower transaction taxes are in effect, what's the attraction for investing in the equities market now?
Well, the anchor really is about earnings growth and GDP growth. Our GDP, as I've said, is strong. That's going to anchor our earnings, corporate earnings growth. The second quarter corporate earnings are going to come out, and I think it's going to show a bit of an acceleration from the first quarter. We've seen the first quarter like really flat, 3% growth year on year, and then on revenues of like 4% growth year on year. But because of the election in the second quarter, election is pending, and then summer month, we are seeing all of the shipment and the exports and all the construction activities. We're expecting like a bit of an acceleration from the 5.4% GDP growth and correspondingly an increase in the earnings growth. But all of this is not going to push the PCA back to 7,000. We need to have policy support. That's why we're expecting like 50 basis points more cut on the part of the BSP policy rate cut to propel the PCA to the target. Our forecast for this year is 7,000. Our brokerage is 6,900. And that's really underpinned by continuing GDP growth, corporate earnings, and policy support on the part of the BSP, 50 basis points. But one more important thing really is the Fed, how the Fed is going to behave. So far, the Fed has not cut, but we are expecting like more cuts towards year end as soon as US economic data comes out very weak as a result of this tariff induced inflation, because that is usually the weakening US economic data usually comes later after the inflation hit.
Right,
That
so
is
it's towards the end of the
timeline.
year in terms of a Fed rate cut. So in what way does that diminish the leeway that the Banco Central has when it tries to think about the interest rate differential that it has to preserve?
It doesn't really diminish. Actually, it enhances the ability of the BSP to cut because the yield differential now is going to narrow. Earlier, like year end 2024, the differential between the US dollar and peso yields, the key rate of the US and the key rate of the BSP is about 125 basis points. And because the peso dollar was very weak early in the year 58.12, we were at 58.12, the BSP was very careful. And our inflation January of this year was like 2.9%. And we are still in the process of coming down. But when we saw the peso is strengthened to 56.35 now, we're doing at 56.35, that strengthens the BSP's ability to cut more. And of course, the dollar has been very weak and it's now at a multi-year low, the dollar index, which was at its lowest since March of, I think, October of 2022. So it's at a multi-year low and the dollar is expected to even depreciate next year when the Fed further cuts. So which means the peso has room to appreciate and therefore that gives the BSP flexibility to cut. And that's really very good in terms of the support that it gives to the PEZA. Historically, that has been the trend. The PEZA rallies every time inflation goes down and we have more rate cuts from the BSP and more from the Fed going into 2026.
Yeah, point on inflation, as you say, it's as low as it gets from here on out, so the trend is moving higher. So to what extent might that constrain the Banco Central from moving any faster?
I think we have to really accept the fact that we are very much vulnerable to the Middle East crisis, this military conflict, which is causing a lot of volatility in the oil prices. This geopolitical uncertainty is not gonna go away because there is this ceasefire and it's not being accepted yet. And Trump is saying it's already been approved by Israel, but we have this always this expectation that something can go wrong and that Iran might retaliate. Of course, we have this lull, and so that's going to keep the BSP very vigilant, and it has come out with a forecast of 1.1 to 1.9% for the month of June, which is a bit higher from the last inflation print of like 1. The forecast then was like 0.9. That was the lowest end. And I think that is going to put some expectation that indeed inflationary expectation might go up. We have seen oil prices go up by pesos, although the oil prices have been cut by 3 pesos. So some offsetting mechanism there, but still the expectation is towards more inflation, more inflationary pressure, but it's still below target. That's the most important thing. 2.2% to 4%. That's the forecast. Inflation target. We're still in the 2%, 2.5. So still, I think it's very solid for that the BSP would have some room to cut.
All
And
right. Well,
also
we'll know in
the
24 hours with the official inflation estimates, inflation data come out from the Philippine Statistics Authority. Thank you so much, Chris. I appreciate you keeping us up to speed there. Christina Ulang of First Metro Securities. And you're watching Money Talks. Coming right up, a trade deal that would allow American goods to enter Vietnam duty-free. And IWG is betting strong demand for hybrid workspaces here in the Philippines. Mark Descruzaile, CEO, Middle East, Africa, and Asia Pacific at IWG, joins us live. Keep it here on One News. Welcome back to Money Talks. I'm Cathy Yang. Just 6 days before U.S. President Trump's self-imposed tariff deadline, he announces that the U.S. and Vietnam have struck a trade deal, allowing American goods to enter the country duty-free. In a post on Truth Social, Trump says the U.S. will charge a 20% import tax on Vietnamese goods, down from the 46% that he announced in April. In addition, Washington imposes a 40% levy on any transshipping, which refers to goods from other countries that pass through Vietnam on their way to the U.S. This has been a priority during negotiations as the Trump administration criticizes countries like Vietnam that act as a channel for Chinese manufacturers to bypass U.S. tariffs and funnel goods into the country. Stepping up on his attacks on the Federal Reserve Chair, Trump calls for Jerome Powell to resign. On Truth Social, Trump attaches a link to a news article about comments from Bill Pulte, the head of the Federal Housing Finance Agency. Pulte accused the Fed chair of political bias and deception during his Senate testimony. He also claimed that Powell made false statements in denying reports of lavish activities in the Fed's headquarters planned renovation, such as a VIP dining room and a new marble table. Trump and Powell have been at loggerheads with each other over the pace of the Fed's rate-cutting cycle. U.S. markets have ended Wednesday's session a mixed bag. The Dow falling by less than 0.1%. S&P 500 and the Nasdaq reached fresh records, and the S&P climbed by nearly 0.5%, and the Nasdaq rose by nearly 1%. Benchmark 10-year Treasury yields ticked higher to 4.29%, and gold prices settled to $3,348 per troy ounce. Stock futures are little changed, but pointing to gains when the markets open later tonight, Manila time. The Dow, the S&P, and the Nasdaq are all up by less than 0.1%. As for Asian markets, they're looking mixed in the first hours of trading this Thursday. Australia's ASX 200 down by 0.33%, South Korea's Kospi up by 0.9%, and Japan's Nikkei 225 rises by 0.1% as well. Del Monte Pacific Limited says its U.S. subsidiary Del Monte Foods has filed for Chapter 11 bankruptcy and is now looking for potential buyers. The filing, made on July 1st in a New Jersey court, gives the company access to over $900 million in financing to continue operations while restructuring. Del Monte clarified only its U.S. operations are affected. Its Asian and international units, including Del Monte Philippines, remain profitable and fully operational. DMPL is also considering removing the U.S. unit from its consolidated group, which may lead to a major impairment loss after the audit. Still, analysts believe cutting ties with its money-losing U.S. arm could help DMPL recover and become profitable by 2026 or 2027. International Workplace Group, the world's largest provider of hybrid working solutions, sees stronger momentum for flexible workspaces in Metro Manila, as well as emerging hubs such as Pampanga, Cebu, Davao, and Bohol. With us now for more is Mark Descruzaire, the CEO, Middle East, Africa, and Asia Pacific at IWG. Welcome to Manila, Mark. Thank you so much for joining us.
Thank you, Cathy.
And congratulations, you've been in the job for a year.
Yes, absolutely.
You must have traveled. It's a huge demographic that you cover. It's the Middle East, Africa, and Asia Pacific. And now here, you're in a sub-region, the ASEAN and the Philippines. How does the Philippines stack up against all the other markets that you watch? And
Thank you, Cathy. It's really interesting because ASEAN in general has been moving quite steady in recent years, and the Philippines has been catching up. So probably some other markets were a little bit ahead of the game when it comes to getting into the flexible spaces. And today, I would say that probably this is the fastest growing market here in the Philippines. It took us 20 years to get to 20 centers that we opened in the country. And in the last 2 years, we have just doubled the numbers. And we are actually now getting into opening up to 70 centers in the next couple of years.
Is it? I mean, the last time I checked, you started the year with saying you're going to be growing by 50% in the number of centers in the Philippines. Has that grown then?
Yes, correct.
In the last couple of months?
No, absolutely. And I just learned from the team when I landed here yesterday that we had signed another 2. So it means that today we have a pipeline of 30 more centers to open in the next couple of years. And there is more coming as well because we don't stop.
Right, and you're not stopping at a time everybody else is pausing and waiting what goes on with the geopolitical tensions in the Middle East and whatever Trump says about the deadline on July 9th with the tariffs. With all that uncertainty, one would think that businesses might also pull back on their capex and also on investing in a workplace or workspace.
What is really interesting as a trend in our industry is that we're moving away from having the conventional type of leases in the various buildings, and all the real estate for offices is really changing completely. And what we are actually working towards is this big trend of people getting into hybrid type of spaces, which means that they will get more options, more alternatives, which are not just in the city centers, but also in the provinces, into secondary markets. And there are many different options that the people can actually get, and they will want to be able to work closer to their homes. They might not want to commute. For instance, here we can see commuting is not very easy. So there are a lot of smaller spaces in different buildings with different opportunities, which is very much what the market wants. And this is this longer trend that we're looking at instead of just the current instability that we can see in the world.
So it's what the market wants, meaning the companies are finding that there is a lot more savings that can be had if they do flexible workspaces? And they're coming here to the Philippines because they're seeking a haven, perhaps?
Well, companies realized that post the pandemic, they were having these large offices with not so many employees anymore. And employees demand that there is flexibility in the way that they're working. It's not a Monday to Friday systematically anymore. And therefore, there was this realization from the CEOs and CFOs that, okay, we need to use this space differently. We need to actually reduce the number of square meters that we're using. We need to be smarter at doing it. And therefore, probably, instead of investing into stacking up our offices, it's actually better maybe to have turnkey solutions already completely made and organized for them, which is very much what we're doing.
Okay, so from the pandemic, it's a worker speaking up and saying, I gotta have better work conditions here, I want a flexible workspace. And now you're seeing that the demand is not only in Metro Manila, but in the regional centers. Where are those growth centers and what's driving them here in the Philippines?
So we have, for instance, signed, and then we have centers in Bohol or in Cebu or in Angeles City and many other different places and provinces and cities. I will not be able to mention all of them because we're already expanding in many. And what is really interesting is we have different brands. So we have not just Regis, which has been the historical brand, but we have, for instance, HQ, which is a more economical type of brand with a different solution, very functional, which could be an amazing opportunity for secondary markets. And we see there is also this demand for, we're talking a lot about the digital nomads, for instance. So you don't always work from one place, and therefore you might be able to work in certain weeks or certain days of the week in other places, which might be whether you also want to spend the weekend at the same time. So you're combining work and leisure, and we're offering options for these people who want to have these different opportunities.
Interesting as well, the landlords and strategic partnerships that you have, very critical in your business model, come from different sorts. They're groceries, they're maybe even from government agencies. What are you finding are the best partnerships to be had, and in maintaining probably operational costs as costs go up because of all the global uncertainties out there?
What is really interesting is that our model has shifted completely. We used to actually take a lease, and we would be organizing ourselves and taking just the opportunity to do whatever we wanted in the space we had actually leased. And now we found that it was much more interesting to get the landlords to become our partners. And therefore, we are in this together. So the way we are actually now developing and getting this contractual relationship with the landlords is that we are signing together a partnership whereby we are actually managing the space and organizing it. And it's very interesting for us because we invest today a lot into digital distribution channels, the marketing, which we need to do on a global scale. But locally, the people that are the most relevant will be the local people of each of the countries, each of the cities. So we're relying a lot on the partners to actually get the best buildings, the best plots. And sometimes it will be into shopping malls. Sometimes it's going to be into hotels. It can be different type of spaces where we find the opportunity to occupy the space and actually maximize the return for the partners in a better way. And there are different types of partners. So you mentioned some of them. We need to have the same mindset, we need to have the same vision together, and this is usually when it works very well. And for me, the real test is to see that we can sign one center with a partner, and the partner will come to us and say, well, why don't we have a second one, the third one, which we have now with many of them. So that's very, very much what we are doing, is these strategic partnerships where we will have multiple centers together with the same partners.
Right, but when you talk about the regional growth areas, there are differing maturity levels, if you will, in infrastructure that you wouldn't get here in Manila or the National Capital Region. So what's the work around there to be able to deliver the same kind of seamless service as one would find in the NCR and in the regional growth areas?
This is where we need to be creative. Our teams here are being creative, and they are in this discussion with the investors, the landlords, and convince them that there's a different way to utilize their space. And therefore, multipurpose buildings or developments are really interesting because you end up having the people who will be working from our center, but at the same time, they will also have the retail options that can be in the same building. It might also be residential at the same time. And this type of multi-purpose developments we see in many markets here as well. And we have examples where we have actually converted part of a shopping market, shopping center. And all of a sudden, there is a better utilization of some of the space. And therefore, we are quite creative in the type of buildings we're utilizing. It's not just purpose-built office building, not at all. And this has really shifted, and it is quite a new trend, which we're experiencing here, in particular in the provinces.
So better yields for those landlords working with you, signing strategic partnerships.
Absolutely, and managing the risk better, because you have different cycles, and we are typically not working so much with the cycles, and therefore that provides an opportunity for them to get a better yield. Absolutely.
All right, so where do we find you next? You've just mentioned there an expansion of more than 50% growth for the year.
Yes. Well, we will reach 50 centers by the end of this year. And we will be opening in various places, like Bohol, for instance. So yes, that's really coming, and it is definitely a Manila story as well, because we want to continue to expand in Manila and different suburbs and different districts, but it's also very much getting into the provinces, into the different islands and places that we have here in the Philippines.
All right, looking forward to finding one near my neighborhood. Thank you so
Thank you so
for
much.
joining us.
Thank you, Cathy.
Mark Descruzalle, the CEO, Middle East, Africa, and Asia Pacific at IWG. And that is it for Money Talks. I'm Cathy Yang. Catch us again tomorrow, 9:30 a.m. here on One News. Have a great day ahead. Stay dry.